The phones rang before dawn in Saskatchewan. But it wasn't buyers calling. It was cancellations. 3 million tons of canola wiped out overnight. By sunrise, $1.5 billion had vanished. Rail cars were loaded. Ships waited in Vancouver. Now all of it useless. Beijing didn't explain. It didn't argue. It rerouted. By morning, the same orders carried a different flag. Australia, the country Ottawa never targeted, was suddenly the one China rewarded. Farmers stared at full silos. Brokers stared at dead contracts. Ottawa stared at Washington, hoping for support that never came. Was this retaliation for steel tariffs? Or a colder message about who's truly expendable in China's supply chain? The next knock came at the bank. The fallout had begun weeks earlier. In July, Canada's Prime Minister stood at a podium in Ottawa and announced a 25% tariff on steel products containing Chinese components. No warning. No phase-in. The official line, protecting domestic industry from global overcapacity. But behind closed doors at the Trade Ministry, the story was different. Washington had just hit Canadian exports with a 35% tariff. Ottawa's sudden turn against Beijing looked like a peace offering to ease U.S. pressure. The strategy was simple. Target Chinese steel, win back the U.S. market. But the calculation was wrong. China's response was swift and surgical. Within days, Chinese importers, both state-linked and private, sent identical termination letters to Canadian grain companies. Effective immediately, no more Canadian canola. No exceptions. This wasn't a diplomatic signal. It was a $1.5 billion rerouting of global trade. Ships in Vancouver sat idle. Containers on prairie rail cars baked under the summer sun, where canola molds and spoils fast. By week's end, new contracts were inked in Canberra. China committed to buying up to 3 million tons of Australian canola over the next 4 years. For Australia, it was an unlikely comeback. Since 2020, its canola had been shut out of China over quarantine disputes and blackleg disease concerns. But now, those restrictions vanished almost overnight. The irony was hard to miss. Australia had aligned closely with U.S. policy against China on defense technology and trade, yet was welcomed back into Beijing's good graces. Meanwhile, Canada, another loyal U.S. ally, was frozen out. And Canada's vulnerability was unique. In 2024, more than a third of its canola exports went to China, supplying nearly 40% of China's total demand. That's not diversification. That's dependence. Canadian canola is among the most efficient oilseed crops globally, with an oil yield of around 44.6%. It's highly prized in Asia for cooking oil production, but efficiency means nothing when the buyer walks away. In Saskatchewan and Manitoba, farmers opened storage sheds to rows of yellowing seed piles. Futures markets crashed, plunging 12% in a week. Equipment dealers saw orders canceled. Rural banks began restructuring farm loans, bracing for defaults. In Ottawa, trade officials spoke in calm tones, saying they were exploring new markets. Diplomatic code for scrambling to find buyers in countries with neither the capacity nor interest to absorb millions of tons of surplus canola. Australia, on the other hand, wasn't sitting on a glut. It was expecting one of its smallest harvests in 5 years, with production down to 5.7 million tons due to poor weather. But Canberra played the long game. In July, Prime Minister Anthony Albanese flew to Beijing with agriculture officials and industry leaders. They negotiated phytosanitary protocols, organized trial shipments, and set a timeline. Within days of returning, Australian traders were booking vessels. The short-term volume didn't matter. What mattered was locking in China's long-term demand before Canada found a way back. Russia also saw the door open. A decade ago, it barely produced 500,000 tons of rapeseed annually. By 2021, it was producing 2.8 million. Last year, it hit 4.22 million. Projections for 2025 put it near 5 million, with Siberia emerging as a major supplier. And unlike Australia, Russia had momentum. Its rapeseed exports to China had tripled year over year. Moscow was building a new grain transit hub on the Sino-Russian border, designed to accelerate exports of oilseeds, soybeans, and grains into northern China. For Beijing, this wasn't just about punishing Canada. It was about insulating itself, diversifying supply chains so political loyalty mattered less. If one country became unreliable, another would step in seamlessly. That principle had been used before on soybeans, rare earths, even consumer electronics. Now it was canola's turn. Canada's vulnerability wasn't just agricultural. It was structural. Over 70% of its energy sector and half its manufacturing were tied to U.S. capital. 3/4 of its exports went to the American market. This left Ottawa with little room to maneuver. Confronting Washington was politically risky, but accommodating it, that came with costs elsewhere. This time, that cost was counted in warehouses full of unsold grain and the political backlash of a furious farm lobby. And the steel tariffs that triggered it all? They weren't even economically critical. Chinese steel made up just 18% of Canadian imports, far less than the share coming from the U.S. But symbolically, the move aligned Ottawa squarely with Washington's anti-China trade posture. And in trade diplomacy, symbolism is never free. Beijing saw the signal and responded with one of its own, targeted, painful, visible. Let's pause here, because what stands out most isn't that Canada lost the Chinese market. It's how fast Australia took it. Less than a month separated Canada's tariff announcement and the signing of Australia's canola deal. That wasn't improvisation. That was preparation. In Western and South Australia, ports like Albany and Port Lincoln were already optimized for bulk grain exports to Asia. Shipping time to China is just 7 to 10 days, less than a third of Canada's 30-plus day trans-Pacific route. In commodity trading, that's not just a logistical edge. It's a financial one, lowering freight costs and reducing spoilage risk. So when Beijing went looking for a replacement, geography mattered as much as geopolitics. Meanwhile, Canada's own logistics became a liability. Prairie grain has to travel thousands of kilometers by rail to reach Pacific ports, vulnerable to bottlenecks, labor disputes, and weather. Delivery timelines can stretch by weeks. In a competitive tender, those delays are part of price, and in this case, part why Canada wasn't even considered. The political fallout hit fast. Farm groups accused the government of sacrificing agriculture to score symbolic points in the steel sector. Opposition parties demanded inquiries into why alternative buyers hadn't been secured before provoking China, Canada's largest AG customer. In Parliament, ministers insisted they were exploring new markets in Europe and Southeast Asia. But trade analysts knew better. Europe already produces its own oilseeds. Southeast Asia's demand is fragmented and dominated by cheaper palm oil. Worse still, the U.S., the very market Canada had hoped to appease, offered no relief. The 35% American tariff remained firmly in place. In effect, Ottawa had traded a guaranteed high-value customer for the vague hope of future goodwill. That goodwill never materialized. For China, the move wasn't just about canola. It was strategic. The message to suppliers worldwide was clear. Access to the Chinese market comes with conditions, and replacements are always ready. For Australia, the win went beyond agriculture. It was proof that past tensions could be set aside when economic incentives aligned. Earlier disputes over wine, trade freezes, even national security were quietly shelved in favor of opportunity. Russia's gains were more discreet, but no less strategic. Its growing agricultural sector, paired with infrastructure focused on exports to China, positioned Moscow as a key fallback. If Australia or Canada ever faltered again, Russia would be ready. And by building that capacity now, the Kremlin was signaling that it could provide both supply and leverage when Beijing needed either. By late autumn, the shift was visible in the data. Chinese canola imports from Canada had collapsed to nearly zero. Australian shipments, though modest due to a weak harvest, were set to rise sharply in the next season. Russian volumes were already hitting record highs. For global commodity markets, this was a real-time demonstration of how swiftly trade flows can shift when politics intervene. But in rural Canada, the consequences were personal. Storage bins were overflowing. Farmers were paying out of pocket to preserve product they couldn't sell. Prices stayed low. Credit lines tightened. Banks began pulling back on loans for the next planting season. Canola, once a symbol of Canada's agricultural strength, had become a cautionary tale. The larger lesson? It was about leverage and who really has it. Canada had assumed that siding with the U.S. on China would earn relief from American tariffs. Instead, it discovered a harsh truth. In today's fragmented, flexible supply chains, leverage doesn't come from loyalty. It comes from being irreplaceable. And that's what stings most. Because in just one season, Canada proved it was replaceable, and Australia proved it wasn't. Thank you for watching this video. Please like and subscribe.